BAE Systems rose just 1.5% on the day the UK government announced its biggest defense spending commitment in a generation. Starmer delivered that announcement standing inside BAE's own drone factory in Berkshire. The bottleneck is not what the dip promises, it is what BAE's existing backlog already contains. The £15 billion defence investment plan confirmed £63 billion for nuclear deterrence, Dreadnought and SSN-AUKUS submarine programs, and more than £5 billion over 4 years for drones. Every major program named runs directly through BAE Systems. Yet Chemring surged 5.8% on the same day. Melrose gained 3.4%, and Rolls-Royce added 2.7%. The largest named beneficiary posted the smallest gain. This is not a coincidence of market noise. Capital rotated deliberately toward the smaller, less backlogged names and away from the prime contractor. The market was not ignoring the dip. It was reading something in BAE's position that the political narrative obscured. What it read begins with an £84 billion number. BAE Systems enters the dip with a record £84 billion order backlog. That number, highlighted by Morgan Stanley in its pre-dip note, is the reason the share price barely moved. A backlog of that scale means BAE's revenue pipeline is already allocated years into the future. The dip does not add new contracts. It confirms the political intent to honor and extend what was already expected. For a company with years of contracted work already secured, the dip removes uncertainty but adds very little incremental cash flow in the near term. That distinction matters for valuation. Smaller defense names, Chemring and ammunition, Melrose and aerospace components, carry thinner order books and narrower government commitments. For them, the dip represents new business. For BAE, it is confirmation of what the backlog already priced in. The market priced the two situations accordingly. There is a second layer that compounds this read. The funding plan for the dip has a structural hole. Government figures confirm that the next chancellor will need to find almost £5 billion over 4 years to complete the plan, roughly £2 billion in the 2026-2027 financial year alone. The previous defense secretary resigned earlier this month over an £18 billion funding gap that had not been closed. The dip resolves the political narrative, but not the fiscal arithmetic. For BAE's long-cycle programs, submarines, fighter jets, nuclear infrastructure, the question is not whether the commitment exists on paper, but whether the cash drawdowns arrive on schedule when the next government faces a constrained capital budget. BAE CEO Charles Woodburn said the plan provided much-needed clarity for industry. That language is significant. Clarity about strategic direction is not the same as clarity about cash flow timing. A holder who bought BAE expecting the dip to unlock near-term earnings acceleration should note the distinction.
Morgan Stanley named BAE Systems its top European defense pick in the same research note in which it cut its price target from 2,662 pence to 2,420 pence. The overweight rating and the target cut sit in the same document, addressed to the same fact set. The note cites BAE's global exposure to rising defense expenditure in the United States and the Middle East, its record backlog, and its diversified revenue streams as the investment case. It also says the shares warrant a premium to major U.S. defense contractors. Then it lowers the number at which it thinks the shares are fairly valued. The logic is not self-contradictory, but it requires a precise reading. Morgan Stanley is saying BAE is the best-positioned European name on a structural view, and that the current price, after a 16% decline over 3 months, is attractive relative to long-term earnings. The target cut reflects a higher discount rate and lower sector-wide multiples, not a change in BAE's operational story. The gap between the structural case and the near-term repricing is exactly what creates the hold versus add dilemma for existing investors, and the entry versus avoid dilemma for those on the sidelines. The counter-evidence against an immediate re-rating is not weak. The DIP's funding gap is real, and BAE's programs are multi-year commitments, whose cash conversion depends on drawdown schedules that the next chancellor controls. The main risk is not that the programs are cancelled. GCAP and Dreadnought carry too much political and strategic weight for that, but that the pace of conversion from backlog into recognized revenue is slower than the current consensus assumes. For a holder, the position becomes an add if confirmed Dreadnought spend drawdown rates in the H1 results match or exceed what the backlog implies. It becomes a reduce if management signals program delays or revises its conversion timeline. For a non-holder, the entry setup requires that same H1 confirmation. BAE at the current level after a 16% pullback is not a momentum trade. It is a thesis about the gap between the backlog value and the current market capitalization closing as contracts convert. The trigger is the H1 2026 results, with an earlier leading signal in any disclosed GCAP or Dreadnought milestone payment. If those drawdowns confirm on schedule, the DIP's clarity becomes cash. If they slip, the 16% decline resumes. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.